Okay, so for question 5, let's quickly go through that. For question 5, they asked you to calculate your taxable capital gain or the assessed capital loss for the information at the top based on the year ended 30 June 2020. Now, the fact that this is 25 marks tells you already that there would potentially be an asset acquired before 1 October 2001, which means you have to go apply the valuation date value for the calculation. Okay. Otherwise, if it is straightforward, it would not be more than 10 marks. Okay. So the fact that it was 25 marks already gave away the fact that there is something different to this. So let's go see what information they give you. So they tell you we are a manufacturing company and is not regarded as a small business corporation. So we apply the 28%. And they tell you we've made the following sales of assets, and the company had an assessed capital loss of 65,000 for the 2019 year of assessment. Okay, so that information is important. We are going to apply it when we work out the net capital gain. So we see there's 2 items. The first one was the factory purchase 1 June 1999. So this is pre-1 October 2001. So we have to work out the valuation date value. Okay, now the valuation date value will be based on whether our proceeds are more than the market value at that specific date. Okay, when we sell it. So let's quickly see, we purchased it for 1.9 million and it was sold for 2.8 million on the 31st of May 2020. They tell you the cumulative allowances to date is 720 and the sales commission of 4% of the selling price was paid. Okay, so sales commission is 4% multiplied with the 2.8 million will give you the sales commission value, and that is a post 1 October cost that you include to your base cost. Then they give you the market value on 1 October is 1.7 million. The time apportionment based cost was 1.6 million. Now what they don't give you is the 20% of the proceeds that you have to add as well. So you've got 3 methods in which you have to base it. Okay. Now they've sold it for more than 2.8 is more than your market value of 1.7. So for that reason, you apply the higher of the 3 methods when you work out the base costs. Then the next one is we had the warehouse. It was purchased new on 4 April 2013 for 980. So this is straightforward. And due to the fact that there were riots, they decided to sell it. They did extensive advertising and that cost 26,000 to sell this property. And because of what's happening, the highest offer they received was 480,000. And it qualifies for Section 13 Quin allowance. So that is your 5%. Okay. Now let's go do the calculation. So what you had to see here is we had a property data prior to 1 October. So the big thing there is working out what is the tax or the base cost based on the valuation date value. And the second one, we actually sold it at a loss. And then we need to see whether we are allowed to deduct that loss from our taxable income, or are we only going to apply it for capital gains purposes. And then the assessed capital loss carried over from the prior year needs to be accounted for. Okay, so I'm going to stop sharing this and then I'm going to share the Excel file that I'm going to use. Okay, so let's start with our factory. So the first thing when you do the factory, you create a table like this. So you show your pre-1 October cost, you show your post-1 October cost, and your total cost. Okay. Now, the reason we split it between that is because when we work out the 20% of the proceeds, we are allowed to use the post-October cost to deduct it from the proceeds to work out the value. And we also add those post-October costs when we work out the base cost. Okay, so they've told us the cost of this was 1.9 million. So you go fill in the cost as 1.9 million. Okay. There was no post-October cost relating to the purchase of it. Our tax allowances that we were allowed to deduct, they have told us we have deducted 720 up to this stage. Okay, so they have given us the allowances we have already claimed, which means our tax value when we sold it was 1.1 million. So 1,180,000 at the date we sold it. But we've also incurred an additional cost in trying to dispose of it, which was our commission of 4%, which you're allowed to capitalize. And that is the 4% of the 2.8 million, which gives you 112,000. So that means our pre-October cost is the 1.18 million, whereas the post 1 October is the 112,000, which means our total cost for that property is 1.292 million. Okay. Now, to work out our gain, we first have to go work out the recoupment. So step 1 is the recoupment. Okay, the recoupment is limited. The 2.8 is limited to our original cost of 1.9 here, less the tax value at the date we sell it. So we've got our recoupment value of 720. Now that recoupment value, if you had a big question, would be included as part of your taxable income calc, but because they only ask for your capital gains and loss, you just show it separate. Okay. Now that recoupment value then impacts our proceeds amount that we have to work out. So our proceeds now is the 2.8 million, which we sold it for, less the 720 is our new proceeds value. But our base cost value, we will have to go work out based on separate calculations because of the fact that it predates 1 October. Okay, let me just show you what the mark allocation would be up to this stage. So up to this stage, you would have already scored 7 marks out of the 25 just by doing basic principles. Okay, so the base cost now, we are going to go work it out. So we say the valuation date value is based on which method we apply. So because our proceeds is that 20.2 million and 80,000 is more than the total cost of this asset. We apply paragraph 26, which says you apply one of the 3 methods. The higher one you use as your base cost. If the proceeds was less than that, you would only apply your market value and your 20% of your proceeds. You would not apply the time apportionment based cost method. Okay. Let me just wrap here so you can read it. Okay, so based on the information they have provided to you, they have given you the market value of 1.7 million. They have given you the time apportionment based costs. So these they have already given you. Okay? And then you have to go apply the 20% of the proceeds. But how we work out the proceeds, Okay, so how you apply the proceed is you take the proceed and you deduct any cost after 1 October 2001. So that 112,000, you deduct it off the proceeds value to work out the 20% of the proceeds amount to get to a value of 393,600. Okay. Now, based on that, we are going to apply the highest one. Now, which one is the highest one? The market value. Okay. So, because of the fact that the market value is the higher one and does not exceed your proceeds, it's not more than the proceeds amount, we will use the market value and then we will add the cost after 1 October 2000 to that value to get to our updated based costs. Okay, so I'm going to scroll up for you. Okay, so let me just repeat. So because of the fact that a market value was the higher out of those three values, we do the market value as our valuation date value. That's what we would elect. And then we add any cost we've incurred after 1 October to that value. So that was that 112,000, which was the commission. You add to that, and then your base cost is the 1.862 million. And that is what I bring here into the calculation at the top to work out my gain. To work out the capital gain of 218,000. So that's for the first asset. Okay. Then the second asset, because the second asset is a new asset, we will first have to start with what is the cost. We know they get a section 13 quin allowance, so we have to go work out what is the allowances we were allowed to claim up to that date to work out a potential recoupment and then as well work out the capital gain. Okay, so we start as follows. We start with the cost, which is the 980. Then section 13 quin is 5%. Now that is also per year. Now we started in 2013 in April. So we would have done 2013, 2014, 2015, 16, 17, 18, 19 as the year before. 7 years is what we've deducted up to that date. Then for the current year, we would deduct another 5%. So our tax value at the date of sale is 588. But now we have to go work out the recoupment. We've sold this for 480. Okay, so we've actually sold it for less than what it's worth. So then we get a section 11 allowance. You would be able to work it out. So our 980, which was our original cost, is now limited to the 480, which is the actual sales value, which is the lower of the two. And we deduct the 588 of 108,000. Okay, but the rule says, because of the fact that this is a capital building, we will not be able to claim that as a deduction in our taxable income in terms of section 11.0. Because it only relates to your movable assets and not to your immovables. So what will happen is I will actually claim this now as a capital loss or part of the capital loss calculation. So my proceeds is the 480. I do not have a recoupment, so it's 0. My base cost is the 980, so my original cost less my allowances. So if you add these together, you get the 392,000, and then we add the 26,000, which was the advertising cost. You add that to the base cost to get a base cost of 614,000. So then the loss that I've made now, based on the capital rules, is 134,000. Okay, so because of the fact that I cannot take that 108 into account for my taxable income, that is why we haven't adjusted it yet when we work out the proceeds and the base cost. So what we are in fact doing is we are taking the capital loss into account and deducting it from our profit that we made on the other asset of 218 to get to the aggregated capital gain value of 84,000. But now the next step to get to the net capital gain is we have to deduct any assessed capital losses that are carried over, which was this 65,000, which was in the question, to work out the net capital gain. And once we've calculated the net capital gain, that is where we apply the 80% for our taxable income inclusion. Okay, so we apply the 80% and then you will include in taxable capital gain the 15,200. Okay, and that is how you would do question number 5. Okay, do you guys have any questions on the capital gains? This is where a lot of students would have lost their marks because of the complexity of this type of question. And 25 marks out of 180 is quite a lot. Okay, so do you guys have any questions on capital gains or on the solution?